Hello, everyone. This is Chris Martinson. It is March 9th. It's just after market close. And as you know, I've been covering the coronavirus pretty extensively, really from a medical standpoint and from a preparation standpoint, and giving is the best advice I know how to give so that people can understand what this virus is all about so they can prepare and be safe. And hopefully we can help avoid overwhelming our medical system if we get the right information out there. So that's most of you may know me through that work, but of course, I've been doing other work for a very long time before I picked that up. And I've been working on markets, understanding the Federal Reserve, understanding how money works, and all of that. And it's my contention that as bad as this coronavirus is from a health and medical standpoint, it is going to be even more damaging from an economic standpoint. And the reason for that is centered in the idea that we don't have a healthy economy. We had a bubble that was blowing in about 1995, and that it started to blow up, and it blew up in 1998, and then it was rescued, and it blew up again in 2000, and then we had another one that blew up. We call that the housing bubble. And you would think we would have learned our lesson from all of that misery and misallocation of capital, but we didn't, and we, the collective we. And so the Federal Reserve and other central banks have been on this collective bubble blowing experience ever since, and we've been waiting for a pin to come along, and we've been speculating for years. Was that pin going to be oil, the price of oil? Was it a war? Was it going to be something? But something was going to come along that was going to fracture that story, that narrative, and pop the bubble, or the bubbles, because this was kind of the everything bubble. So this is a really important topic for those of you who care about your jobs, about your economy, about your portfolio, about your wealth, about things like that. And this is a second line of thinking that I spend a lot of time on. And with us today is no one better to talk about what's going on in the markets today. And as we're recording this, 4:15 right now, I think the Dow is off pretty much close to 2,000, and S&P was down well over 200 points, and on, right? And so this market carnage was not entirely unexpected. In fact, some people I think will mistakenly say this was because of the coronavirus, but in fact, the coronavirus was the spark. There was a very, very large pile of tinder for that spark to land on, which was all of the misallocation of capital that the Federal Reserve and other central banks had fostered, and the mispricing of risk and all of that. So who better to talk about that with us today than John Rubino of dollarcollapse.com, author of several books, all around great guy, really smart, and understands, I think, bubble dynamics as well as or better than anybody out there. So John, welcome to the program.
Hey, Chris. Well, this is a fun day for us to get together, isn't it?
Oh my gosh.
Not fun for a lot of people, but fun for you and I, since we've been trying to figure out what would pop the bubble for such a long time.
Yeah, well, now we know, right? And the worst of this for me, John, is not worst of it in terms of how this is going to ripple through the markets, is that to have a bubble, and so let's define a bubble for people. A bubble occurs when asset prices rise beyond what incomes can sustain. So what's bubbly? Well, let's think of all the unicorn companies that were out there that were fostered, right? These are companies whose incomes can't even possibly sustain anything because they have no income. They've got negative income, and yet they had valuations in the tens of billions of dollars. Uber, Lyft, money-burning companies, Tesla. These companies had just reliably and traditionally burned money, but they were valued by the market at really high valuations. So to have a bubble, you need those two things. You need ample credit, and that's what the central banks give us, and you need a story. Right? Once upon a time, there were stories like tulips, tulip bulbs, railroads, swampland. There's always a story, right? But this time, the dominant story was the Fed will always bail us out. That was a part of this big story, right? And I guess the other part was nothing bad will ever happen again. It took some real heroic levels of complacency to get us to where we were. And so I think that's when I say something bad's happening, I think it's the narrative, the false narrative is breaking. And so we're missing one of the two critical elements of the bubble is now missing, but let's talk about that. And let's also talk about, I think the other leg is missing too. We have a zero-legged stool here now, which is the credit markets just blew up as well, which is a separate topic, but related. So let's talk narrative. What do you think's going on here?
Well, first of all, when you ask what asset classes are in a bubble right now, it's probably easier to ask what aren't, because just about everything out there now, from trophy real estate to fine art to most stocks to all bonds, just about, are all in bubble territory based on historical valuation. So there are air pockets under pretty much every financial and a lot of real assets out there right now, which means that this could go on for a long time. Now, the bubbles that have popped in the recent past, starting, like you said, in the 1990s, and moving through the housing bubble and this current one, they've been financial bubbles that that could be reinflated via financial means. In other words, you cut interest rates far enough, you pump enough new money into the system, and you can reinflate the bubble. You can get people buying stuff again. But today, something different is happening because we're in the middle or at the beginning stages of, I guess, a global pandemic that is just basically shutting down huge sections of the global economy. And it's not clear how you reflate or how you do away with the trauma of something like that with financial tools. Because would, for instance, cutting interest rates in Italy from -1% to -2% get people back to work when the country has 1/4 of the population quarantined? Or with China, where you've got, what, 500 million people who aren't allowed to leave their houses? There's no way to restart an economy in that kind of a situation. And because we've taken on so much debt to get here, you can't just shut down the economy for 6 months and then come back and restart it in any event, because all the credit that had been taken on, all the debt service that had to be done and isn't being done, leads to mass bankruptcies in even just a few months. You know, you've got apparently thousands of Chinese companies that are on the verge of bankruptcy because they're not getting orders from the West, or they're unable to fulfill the orders they're getting, or whatever. And presumably the same thing is true across most of the developed world. And it's really not clear how the Fed fixes this, but you can bet they're going to try. See, that's what's, I think, most interesting about this coming week is right this minute, they're sitting around a conference table in Washington, D.C., thinking or debating what crazy experimental form of monetary policy they're going to introduce this week to try to fix the bursting of this bubble. And we know probably two things about that. One is that it's going to be extraordinary because there's no reason to go in without something big. You go in small from this point, and the markets will react like they did to the 50 basis point cut that the Fed tried last week. They'll say, "Is that all you've got?" Boom, and then the Dow falls by 5,000 instead of 2,000. So they're going to come in with something big, and there's a decent chance that no matter what it is, it won't work. And that's the end of this game. You know, if you can't reflate using financial means, you really don't have much left, because yeah, the government can run big deficits and the Fed can cut interest rates and produce a lot of new money. But if nobody can leave their house, or you've got mass bankruptcies underway already, which can't be stopped by slightly lower interest rates, then the system is going to, it's going to run its course. You're going to get a market clearing of a lot of this bad debt. And we have so much bad debt that process is just going to be brutal beyond belief. You know, we're looking at potentially the end of the fiat currency, fractional reserve banking system that has basically ruined the world since 1971. And you know what? Couldn't happen to a nicer financial system. It's time we got this over with.
Well, you talked about so many things in there, and one of them is this idea of bad debt. And of course, there are bad debts out there. So we know that there's the zombie companies, which the BIS had the Bank of International Settlements had studied, and just last year they said it was about 1 in 8 companies in the OECD sphere were zombie companies. The definition is this is a company whose operating earnings aren't sufficient to cover even the debt interest payments that they have to make. So that's like, I'm earning 100,000, but the interest on my credit card is 110,000. So what do I do about that? I have to go out and hit the credit markets to borrow more and more money. So that works as long as there's a functioning credit market out there. But this is, and a lot of people maybe don't know this, that, they think, oh, look at all these companies, they've got cash, they've got earnings. But in fact, it's the credit markets that are where so much of that liquidity that allows companies to operate goes. Healthy companies who just need a little working capital, that I have no fault with that. But when you're starting to loan money to companies who have no viable business plan, meaning, they're zombie already, meaning they have no clear way that they're going to actually get to profitability. remember, I mean, this is how crazy it was. It was just earlier in 2019, maybe almost exactly a year ago, I think, when Lyft goes public, and they put it right in their offering statement, right there. Like, I would be so embarrassed to put this in my offering statement. They said, we have no path to profitability, and we're not even sure how we're going to get to there. Right? And the market was like, you're worth $18 billion. Here you go. Right? And that was just like and it made sense to everybody. When the bubbles puncture, though, it doesn't make sense anymore. Right? Suddenly the dust settles and they start asking the good questions again, which is, wait a minute, tell me how you're going to earn money. The same thing your banker would ask you if you were a small business person and you were trying to open an auto shop or a dealership or a restaurant or a landscaping business. They would ask you that very question. Show me your cash flows, and are they positive? And if they aren't, you won't be afforded the same gracious welcome that a lot of these non-cash flowing companies were afforded. So those debts that they're holding, though, for those companies, those go bad quickly. And we're going to see that in so many sectors that were even formerly cash flowing. I think the tourism industry, right? So this is airlines, tourist, locations, places like Disneyland, any place that sort of is predicated on a lot of people getting together and going somewhere to cluster. That includes cruise lines, of course. It's going to, how long before they come back, do you think, right? Could be a long time. And so just pinching off that artery, though, that one, just the travel artery, and saying that thing is now starved for blood, sends a shock through the body of the economy that's really hard to appreciate, I think, for most people. I don't think I fully appreciate it, but I do understand the system effect of that, because it's not as simple as saying, all right, the government's got a quick emergency float some money for American Airlines so they can get through the next few months, and then everything will be better again. There's something happens when you pinch off money flows like that. And you mentioned like 90% of China's economy basically stopped for a month. And it's only like, I think 40-50% back online if you trust the numbers, and questionable, right? So that systemic effect is what worries me the most. Is why I wanted to talk to you about this, because we have to raise ourselves up from, is GE a good buy here? We have to get ourselves up that next layer of sort of altitude, I think, to begin to even begin to understand what's happening here.
Yeah. Well, let's take one more industry to add some specifics to this whole zombie company thing, because I think what's happening today is really interesting from the point of view of the frackers. In other words, the American new age energy sector has been, in the minds of a lot of people, this miracle, this boom, where we figured out a new technology to get oil and gas out of the ground, and we're the biggest oil producer in the world now and everything. But unfortunately, it turns out the wells that are created with fracking technology don't last as long as they were thought to. And huge amounts of money were borrowed in the junk bond market to jumpstart this industry. But now these wells aren't generating the cash flow. Even before today, the wells weren't generating enough cash flow to pay off the junk bonds. And today, oil went down by what was the end, Chris? It was like 30% or something like that, some insane drop for the oil market.
Yeah, it was 30 at the start. I guess it finished down 22%, but I'd have to look.
Okay, but anyhow, an industry that was cash flow negative yesterday is now debilitatingly cash flow negative today. And the amount of junk bonds that are out there related to these companies is bigger than the amount of subprime mortgages that were written back in 2006, when that almost blew up the global financial system. And that's just one small sector in one country. If you look around the world, there are probably 10 more examples of categories of companies that were zombie-ish before, and maybe aren't even walking dead anymore. They're on the ground, and they're getting ready to go bankrupt. So if this doesn't end right away, the rolling tide of bankruptcies is going to be astounding for months and months, and there's no apparent way to stop it.
Well, how do we stop? Let's talk about stopping this, though, because in the past, so when subprime mortgages were blowing up, there were a lot of holders of the collateralized debt obligations, all those fancy derivatives. And so the Fed was able to come in with Hank Paulson, ex-Goldman Sachs banker and leading the Treasury at that point, and take a bunch of taxpayer money and hand it over to AIG and hand it over to Goldman Sachs and sort of plug a few holes But I think those holes were relatively few, even though it was millions of homes we're talking about. The bag holders of that it was kind of concentrated on Wall Street, but this is Main Street, I think we're talking about this time. So I just read right before we got on that some Harvard economist is stepping in front of Congress saying, got to go big, got to go hard. I think $380 billion. Nice specific. I don't know why he didn't say 382 and put some other numbers after that. 380, that's the number. That's the magic number. And it sounds big. 380 billion would be a lot of money. But if we said, well, wait, this has got to go to Main Street, I'm rounding wildly here, but that's basically $1,000 a person, right? So what does that get us? 300, you know?
$380 billion is missing a couple of zeros if they want it to work. You know, this is not nearly enough, because that's Great Recession kind of thinking. You know, those are the numbers that worked back then, and this is way bigger. And it's also different. It's more intractable because it's not a financial problem as much as it is, you know, a public health problem that is shutting down these economies. So it's not clear that there's any amount of money that fixes this, because it's not primarily a financial problem. But I can tell you in general terms what they'll do. They'll have to bail out everybody in sight. When a sector tanks, like let's say the Frackers or whatever, the government is going to have to step in and bail them out. And that's going to be a very open-ended commitment, kind of like what it was when we nationalized the housing industry back in 2008, 2009. You know, we didn't know how much that was going to cost. And it ended up costing a lot up front and making us money, since we succeeded in bailing out the industry and getting it back on track. But this time around, because remember, it isn't just a physical issue, because there's an even bigger derivatives book out there than there was back when. And all of those interest rate, currency, and credit default swap derivatives are out there and were taken on with the assumption of a fairly stable global economy. So you know there are derivatives blowing up in hedge funds across the world and in big banks. So, you know, we could wake up tomorrow and find out Deutsche Bank is bankrupt and being bailed out by the German government or by the ECB. And it's important to understand that we don't know necessarily where an announcement like that is going to take place. Could be Deutsche Bank, could be any number of other things.
And I think the thing I want to help people start to get their minds around is that everything got really super complex, right? So 2008 happens, and this computerized trading was just coming online, and you know, these quants were doing these very sophisticated algorithms and, you know, very sophisticated things that very hard to get your head around, you know, long short arb strategies, carry trades, you know, they're doing all kinds of crazy stuff, right? And we had all those flash crashes that happened, right? We had May of 2010, and then there were little ones, and markets as large as the US dollar flash crash, the treasury market flash crash. So it took a little, I mean, it's a very complex system. I will tell you that I don't think anybody fully understands it, because it's just too complicated, right? And against that backdrop, you know, how many stocks are there? Let's say there's like 5,000, because I think that's the Wilshire 5,000, about 5,000 total, you know, stocks that you would identify by ticker symbols. But do you know, John, the number of ETFs? Do you know that number? I don't know it off the top of my head, but it's many times that number. If there's 5,000 stocks, there's something like 30,000 ETFs sort of built around them, or it's even larger than that. I don't know. But those ETFs are trying to track the movement of those stocks, but many of them don't actually own the stocks. So what they have are derivatives that are meant to and designed to track those stocks. So let's just imagine, to get specific. So let's imagine one of these is trying to track the price of oil, right? And they're long oil, and they just get crushed by 20, 30% all at once. I've heard and read things that are disturbing to say that you know, if you own that ETF and you own a short ETF or a long ETF, you think they're good for it, but it's not so clear how these things are going to behave when liquidity dries up and whether they're even going to be good for it. And I think we're not that far away from seeing a nameplate ETF say, I know you all think you had something in here, but it'll be that scene from South Park, and it's gone. You have any thoughts on that?
Yeah, so basically what we're saying, Chris, stop me if I'm wrong, but I think I get it now, is that there are about a dozen things out there that could implode in the next few weeks, if not the next few days, and any one of which is systemically dangerous, but we don't know which will be first, which will be second, how it'll play out. We just know they're out there.
Mhm.
And they have all taken on risk of one kind or another that is no longer manageable. So basically, here's the dollarcollapse.com scenario that I've been operating on really since 2004. When I started this whole thing, and that is that the system becomes like it is right now, completely unmanageable, wildly over leveraged, and a bubble comes, or a pin comes along to prick the bubble. Things start blowing up. Governments step in to bail out everybody in sight using their fiat currency printing presses. And that may or may not work in the short run, but one thing it definitely does is increase the supply of currency out there. And at some point, that starts to bite in the market. In other words, an oversupply of currency starts to push down the value of the currency, and people start to figure out that the money in their pocket and in their bank account is losing value at an accelerating rate, and they bail on it. So you get the Austrian School of Economics crack-up boom, in which currencies plunge in value. And then it's game over. Then the governments of the world no longer have any tools to fight this thing. And then it's just market forces, which will be absolutely brutal in a system this highly leveraged. So that's basically, in very general terms, the way this probably plays out. And it should be terrifying to anybody who isn't sitting on a pile of gold and silver and 20 acres of farmland, because everybody else is going to suffer dramatically if it does end up playing out that way.
And what does it look like if it plays out that way? Because I mean, this is my only conclusion: is the Fed's going to have to print here, and it'll take on a variety of things. I wrote about this last year. I wrote about it a few days ago. I just saw it show up in the news, and I'm like, oh, there it is. So when I say print, it's not like the Fed physically prints pallets of cash and distributes them all over, like that. What they do is they enable the federal government to go further into deficit spending. So the federal government says, all right, I'm going to take some cash, and then, they squabble over it and they decide who needs it most, and they do their best to sort of put it out there. But the easiest, fairest, fastest thing you can do is give a tax holiday, which is to just say, hey, I know you all were expecting to pay taxes this year, but we're cutting that in half, or we're taking a total holiday this year, which means we're going to have to print up $1.3 trillion. But that's okay. The Fed's over here saying, geez, interest rates are so low, you're good for it. We will, if you issue $1 trillion of bonds, Treasury, we will ship you an electronic $1 trillion, and you can distribute that to everybody as you would normally, right? And then I would get a tax holiday, or they would find some fair way to do it so that rich people got less. I don't know. But, with this thing moving so quick, they would have to pull some trigger like that really fast. But it's ultimately, if you peel away the complexity of Treasury issuing bonds and the Fed buying them on the open market, allegedly, and what happened was the Fed printed up a bunch of money and it went into my bank account, right? That's what just happened there. And that's how inflations get started. And how is that any different than, say, what led to Zimbabwe's currency getting into trouble, or any other currency?
It's absolutely odd. It's modern monetary theory, right? Mm-hmm. Stripping away all this taxing and borrowing stuff and just running the printing presses to operate the government. And it is exactly the same thing that all these other governments did that eventually blew up their financial systems. The difference this time is, well, two differences. One, it's the country with the world's reserve currency doing it, which is borderline unprecedented. And the other is that it's global. It's everybody basically pursuing the same kind of monetary policy. So it allowed us to do this for a longer time than seemed reasonable, because everybody had everybody else's back for a while. But yeah, the laws of finance can be bent, but they can't be broken. If you create way too much of something, then the value of that thing has to go down, or the value of each piece of that thing has to go down. And it goes down slowly at first, and then quickly eventually, because everybody figures it out. So yeah, we're there, and there really isn't any choice but to do something like that. So the question is, can they come up with some new experimental thing that buys us another decade, like the last batch of experimental things did? And since I didn't think QE would work. I thought that was the end in 2008, 2009, and it wasn't the end. So I'm unqualified to make a prediction about whether this is the end or not. But this does have some very big differences that make it harder this time around. And what that means for stock prices, for instance, if the thing the government decides to do is to buy the S&P 500 with newly created currency, I'm not sure whether we would see that as a sign of weakness and sell all of our stocks to the government and just get out, or whether people would say, whoa, the Fed does have our back now, let's buy to infinity, and stocks go up again. I have no idea how that's going to play out because it's never been tried before. But as for the rest of this stuff, if the coronavirus turns out to have legs, and a year from now we're still in lockdown in places and we're afraid to travel to cities and nobody in their right mind would take a cruise or fly in an airplane, then there's only so much you can do with finance to stop something like that. So a lot of it depends on the course of this pandemic, and it's predictable to an extent, but only to an extent. Chris, you're the expert on that, so I wouldn't presume to have an opinion about whether it still will be with us in a year. But if it is, then it almost doesn't matter what governments do financially, because the problem isn't financial, and they only have financial tools. So if their tools don't work, then it's game over. But there are still a lot of imponderables going forward, I guess.
Mm-hmm. Yeah, the basic problem that we're going to face is that this is with us forever. At this point, it'll be like a circulating, thing that will come around. It's going to be, unless it mutates into something worse, and we're hoping it doesn't do that. What's going to happen here is it's going to be a very dangerous version of the cold that comes by every year, right? And that's going to be true until we get to what's called herd immunity. And to get a little technical with the communicability of this particular disease, the R naught, it's somewhere between 4 and 7. So until about 80% of the people have been exposed to it, you don't have what's called herd immunity, meaning it has a hard time moving through your population. Anything under that number, and it just comes through. And of course, you have to balance that against not wanting to swamp your hospital system, because when that happens, then you have all kinds of unnecessary deaths that didn't need to happen, that are above and beyond the normal lethality of this thing. Right. And against that, you have to balance, well, we still need a functioning economy, so what do we do with that? And those three pieces are really hard to play off each other because each one sort of violates the other, so you have to pick what you're going to do in this story. But I think at a minimum, you can say that what we would call non-essential jobs, what David Graeber, the economist, called bullshit jobs, to use a colloquialism, I think a lot of those just go away. Because if they're really actually unnecessary, we'll find out that, we don't actually need those jobs. And in an economy, I think ours wobbled up to 70% service economy jobs. A lot of those go away in this particular environment. And I think
Chris, we'll still need derivatives traders, though, right?
Lots and lots of derivatives, more than ever. But I mean, just to speak of that, I mean, the financial services industry was a very, very large component of the economy. And it does a lot of stuff that, quite frankly, you could say, we could do with a little less of that. I don't want to pick on any one particular thing, but, do we need another investment banker? What would happen if half of them went away, right? Well, probably not a lot, unfortunately, So really, this could mark the end of something really very profound, which is, when people ask me about the housing bubble, I say that was a side bubble. What about the internet bubble? Side bubble. Where's the main bubble? Comes back from August 15th, 1971. That's when we decided we could start growing credit faster than the economy, because we could always grow credit forever. If that's the main bubble, and if that breaks, if all of a sudden people realize what I think is obvious, and I think it's obvious to you as well, is that, oh no, your debts have to match your income. Somehow, some way, those two things have to match. And once you get that in, it's a totally different game, and everything changes. Everything you think about how the economy works doesn't work the same anymore, when all of a sudden, credit still necessary, but what we no longer have unnecessary credit. And we no longer say governments can run perpetual deficits forever and ever, hey Hosanna, and all of that stuff. That's a very different world. And I think there's a lot of functions and jobs that don't get supported, under that environment. I think it's a really big shift.
Yeah. And it's coming on some level, some way, somehow, because so much of what we do, like you said, is unnecessary these days, and it's not supported by cash flow. It's supported by new credit.
Yep.
So when you take out, well, let's see, Doug Nolan at the Credit Bubble Bulletin has been
Yeah.
saying for years that the U.S. needs $3 trillion of new credit every year just to operate. So say that evaporated and we had to live within our means. $3 trillion is what? Is that 10% of the U.S. economy? It just goes away. We can't finance it, therefore we can't do it, therefore it has to stop.
Mm-hmm.
And that's just what we're borrowing to cover. And yeah, so it's going to be a very different world if we can't borrow money continuously.
Mm-hmm.
So the end game here, or at least the best case end game, is the currency reset, in which we just some Sunday night announced that henceforth the dollar is worth 10,000th of an ounce of gold, and going forward, we're going to be debt free at the federal level, and we're going to have sound money, and that's leads to a burst of inflation that impoverishes everybody who trusted the government, but puts us on a sound track going forward. And that's probably the only relatively peaceful scenario that gets us from here to there. Everything else involves civil unrest and maybe civil war, just crazy, crazy times when people just hit the streets because they can't believe they've been screwed over so completely by their government. But anyhow, Chris, I don't know how much time we have left, but do we have time to talk about the gold miners and how what's happening out there changes their economics? Because that's a really interesting story that's actually positive in all of this.
Oh, okay. Yeah, absolutely. Let's go there. And again, I like the way you reframed everything sort of at a higher level to say there's a lot of landmines out there, and there's going to be we don't know where all the risks actually are. The overarching conclusion that I've come to for a long time, and I've been telling people, and you sort of mentioned the punchlines of it, which is, do you have 20 acres of land and some gold and maybe some silver? And those are representations of hard assets. And I'm a big fan of hard assets in an environment like this, because I don't know what the Fed's going to do. I just know they're going to print a lot. And if I'm lucky, they'll print and it'll come my way. And if I'm unlucky, it'll go to somebody else's direction, or whatever. But I can't count on that. So for me, hard assets are the only thing I can be sure of, that when you get to this point of history, which we've gotten to many, many times as humans, just crack open a history book and you're like, oh, people have done this many times, right? We're going to try and print our way, because a little printing today is better than a little pain today, and we'll worry about the future tomorrow, and the future sometimes comes. So for me, the gold and silver fit into a much larger structure of saying hard assets. And to me, those are all things tangible. And so that includes all manner of real estate. Some of it could be commercial, some of it could be residential, some of it could be agricultural, forest land, places with water, mineral rights, gold, silver as already mined expressions of that, and or companies involved in the production of things. And by the way, oil companies will be fine someday, although there's going to be a giant shakeout in that industry. But ultimately, that's the only conclusion I can come to in history, is to say hard assets have protected people in the past from these sorts of moments, and I'm just going with history on that one.
Yeah, and it's happened, like you said, over and over again. You can go all the way back to the Roman Empire, when they had their hyperinflation and their copper coinage plunged in value, but people who had gold and silver preserved their wealth and even increased their capital. So that will happen again, because it always happens in situations like this. But I've been sitting here today watching the gold mining stocks just get whacked along with everything else. The market has thrown the baby out with the bathwater, even though gold mining stocks are completely different animals in completely different situations than, say, tech stocks or global manufacturing companies. Because gold mining is normally not a very good business, right? It's high risk, it's low margin. Very few gold miners make enough money to justify their stock price at any given time in the cycle. But over the past year, the price of what these guys are selling, in other words, the price of gold, is up by about 30%. And their costs, the two biggest of which are labor and oil are way down, especially oil, because today oil plunged and it's down maybe half by 50% or so in the past year. So you got a situation where these big miners out there are seeing the price of what they're selling go up and the cost to get that stuff out of the ground go down, which means their margins are widening dramatically. So they almost alone in the investing universe are going to report really positive earnings comparisons over the next year or two. And I think that makes them, they're still risky. They are not what you would say, like gold bullion or silver bullion. They're relatively risk-free assets. Gold and silver miners do have some risk, but they're going to be really attractive from the point of view of earnings momentum going forward. And I think the fact that they tanked today makes them even more interesting. So they're kind of derivatives of hard assets, which means they aren't risk-free, but they are going to benefit along with the risk asset or the hard asset universe. And yeah. I think today they became even a better deal. And over the next year or so, we're going to find out just how good a deal they are when all this momentum-based investment capital starts flowing into them, because they're the only ones reporting higher earnings. It's going to be a really interesting change of pace for that industry.
Well, that's an interesting analysis. I like that. I think we're just seeing shades of 2008 here again, which is everything gets thrown out because we're in a general liquidity crisis. So we didn't get to talk about it, but the back office things that I'm tracking, which includes the rates at which banks are lending to each other, sort of crevicey edges of the bond market, the triple C areas and stuff like that, all speak to a liquidity crisis. And when cash is short, if you've got it, you sell it because you need cash right then. So this just feels like everything getting tossed, and of course that creates opportunities too, because often that's done without a lot of rationale or thinking or logic behind it. It's structural selling. It has to happen. It's kind of like if I got into a lot of difficulty in my personal life and I had to sell all the contents of my home, you might get some good deals. It's all got to go.
Yeah.
Right. So that's what's happening right now. And of course, if that liquidity crisis goes all the way to a seize up, I guess the last thing I'd like to close with is the other thing that I think people need to be aware of, because it's not a zero possibility, is that the banking system is not all that secure. And particularly European banks, the chart there, they just broke to a brand new 30-year low or something. It's anyway, new lows as far as I'm concerned for an adult lifetime. And there's a very strong possibility that there's a profound banking crisis in Europe and possibly one in the US and elsewhere. And so people just need to be aware that there are laws that got written in post 2008 that are around the bail-in provisions that speak to the idea that if a bank gets in trouble, you as the depositor, you don't have money at the bank. What you have is an unsecured loan that you've made to a now insolvent institution who's going to take your money and swap that back out for equity. Here you go. You own shares in Newco and the new bank. Good luck with those. Hope you have better luck than you had with your deposits. Now, again, we think we have FDIC insurance and all this stuff, but if it's big enough of a problem, they just change the rules. Remember 2008, it was a $100,000 FDIC limit. Then it went to 250, which was good, right? Is there anything that says it couldn't go from 250 back to 1? I don't know. That we'll see how this goes, but I do think that that's a risk people can and should control. And so for me, that's why we work with the people at New Harbor Financial. They control a lot of those risks. That's why we recommend people have multiple bank accounts. That's why we recommend that people have some cash out of the bank. That's why we recommend people have gold as a monetary asset out of the system, because if you don't know how the system's going to behave or you don't trust the system, then it's best not to have all your chips in the system. It's just, one way to look at it. So that's sort of the larger sweep. And it doesn't feel good to be in that position, to think, gosh, what do you mean I can't trust my banking system? But that's my main complaint about the Fed and other central banks, but I'll pick on the Fed because my country. They created a whole slew of potential systemic failure points by just inflating without a clear plan as to how they were going to exit that, when was long enough. I could have made a case, John, for 6 months of emergency QE, but not 12 years, right? And so, I think they really made a giant mess, and I don't know how they fix it at this point, to be honest.
No, they can't fix it. I mean, they found out they can't ever raise interest rates again, right? That was the December 2018 when the markets collapsed
Yeah.
after just a few minor increases in the Fed funds rate. And so the world, at least should have at that point, realized that we will never cut interest rates. Never, as long as this system exists, will interest rates, or I'm sorry, we'll never raise interest rates. They will never go up as long as this system is in place ever again. And that's this gigantic change in functionality for a system, right? Because in the past, raising rates was one of the main policy levers that central banks had to try to manage the economy. Now, you can make the case that they shouldn't be managing anything, but it was one of the things that they used to try to lean against the wind when things got a little too hot. They can never do that again. So, the system is now on autopilot to the extent that ease is the only thing that's possible. We can never tighten again, so we can only have varying degrees of easy money. And yeah, it goes until it blows up. So I actually, a personal thing about what you were saying about banks. 3 or 4 years ago, I had money evenly divided between Charles Schwab, Brokerage House, TD Ameritrade, and Options Express. And then Charles Schwab bought Options Express. So I had most of my money in Schwab. Just lately, they announced they're buying TD Ameritrade. So now everything I have, all my trading accounts, are in one brokerage house, which, like you said, is a dangerous thing to do because you don't know what any individual institution is going to do when things really get crazy. And so you need to spread it back around. But so now I have to think, all right, where else would I put some money?
Yep.
And
Stack of documents this thick and the whole nine yards. Yeah.
Yeah, and it's not even me making these decisions. It's the system consolidating my accounts into one place. So yeah, to the extent that you have all your eggs in one financial basket, you need to look at that because you can make the right investment decisions. In other words, you buy the right assets. But if the institution holding those assets does something that puts you at risk, then you might as well not have bothered. You could have had your money in anything, and if they're going to take it away from you, it doesn't matter, what you invested in. Yeah. So yeah, you need cash on hand to an extent. Some cash on hand. You need gold and silver coins where you can get at them, and you need other real assets like land or a rental house or et cetera, et cetera. That's a long conversation, how to completely move yourself into real as opposed to financial assets. Yep. But we're finding out that now's the time to do that if you haven't already done it.
Yeah. So, so many things to talk about. Last question. Do you think they're going to close the markets?
I think they could. They could end up having to close the markets very easily because, well, let's say tomorrow morning we find out Deutsche Bank's derivatives book blew up. They would probably have to close the markets for a certain period of time, right? And let's say the week after that, we find out that the coronavirus isn't getting better, and that now all of Italy, big chunk of Europe, most of China, and some major US cities are locked down. And then they might have to leave the markets closed for a little bit longer, right? And so there are things that could happen that lead to market closures that last for a while. And that's not historically unprecedented. We closed the market for a long time in the Great Depression. And people need to understand that this is much worse than the Roaring 20s. We're creating a lot more unstable conditions now than we created back then, which led to the Great Depression. So anything that happened back then can easily happen now. And the closing of the stock market is just one of many things that could happen that could short circuit the best laid plans. So we need to take that into account going forward.
Mm-hmm. Yeah, I agree. And it's very difficult to contain all of those risks. So, my metaphor for containing risk is based on that old saying that if you're at a Texas poker game and you don't know who the sucker is at the table after 30 minutes, it's you, right? I don't know where the risks lie in this story. So we covered just a few and we could have covered a dozen more. And when I don't know where the risks lie, I get very defensive and I prefer to take my chips off the table in that environment and pull them off. So yes, having gold allows me to be out of that system. right? And then I don't have to try and analyze, is my bank good, or the suite of banks that I use, are they all individually okay? Or do I have to track and notice which ones might be getting in trouble? And do I have to worry about, this life insurance company and all that stuff, right? I'm a safety kind of a person. I sleep better knowing that I've got my basic wealth stored and out of harm's way, as it were, just until I figure out what's going on. So that's the mark of these times. It's just chaotic. I don't know what's going on. It's happening so fast. I couldn't even figure out, like one year I set myself the task. I said, I'm going to find out just how bad JP Morgan's derivative book is. And I looked at their annual report. Their 10Q was like this thick, right? Hundreds of pages. Couldn't make sense of any of it back there. But ultimately, I found the one paragraph is on page like 145 that said, oh, by the way, management just sort of decides what our derivative book is worth, and that's that, right? I'm paraphrasing slightly, but I realized they probably didn't know what they're doing.
Oh no, you think the average bank CEO understands their derivatives book? Not a chance. and they net their long and short derivatives against each other to come up with a net value at risk number that's really small, really. And what that misses, they put that in their annual report, and it looks like they don't have much money at risk. But what that misses is that for a derivative to hedge a derivative that's on the opposite side of a given bet, the counterparty to that derivative has to be able to make good on it. In other words, you can't have the guy on the other side of your derivatives bet go bankrupt, because then your net exposure, your gross exposure becomes your net exposure. In other words, you're on the hook for the whole thing. So JP Morgan Chase might say they have $5 trillion of derivatives exposure, when in reality it's $50 trillion if the economy blows up. So that's that out there. And two more things about precious metals while we're here. There are criticisms about gold and silver coins that I think betray a lack of understanding of how they work that we could address. One is, people say, well, you know what, you can't eat gold and silver. Why would you even want to bother with it? And the answer to that is that gold and silver isn't a replacement for food or for cropland or something like that. It's a replacement for the dollars that you would have held otherwise. So it's your cash, and you use it to buy stuff when things really hit the fan, and in that sense, just think of it as, if you were going to have $10,000 under the mattress, have $1,000 and the rest in gold and silver. The second criticism of precious metals is that one gold coin is $1,000 and some dollars now, and you say it's going to go higher. Well, what can you do with that? You can't spend something like that at the grocery store. The answer to that is that you should think of silver coins as $20 bills and gold coins as $1,000 bills, and they each have their own use, right? You go to the grocery store with your 20s, and you buy a used car with thousands. So you can just hand over 10 gold coins and get a really nice used car, and use 10 ounces of silver to buy your week's groceries or something like that. So they have two different functions in the financial system, but their commonality is that they're both rare. They're both forms of money that can't be created by governments on a printing press. And because of that, they will hold their value, which is to say they'll go up in dollar terms over time. So that's that story. And that's why you should have some gold and silver coins.
Yeah, and that's going to take a while for that perception to shift, I think. I don't know any stores around here that would even know what a silver coin was, but that'll shift over time, I assume.
Oh yeah, or your neighbors know what silver coins are. So if you're buying something from a neighbor or a friend, they will be very likely, especially in a world where there are headline numbers, gold hits $4,000 an ounce, when that's what people are seeing on CNBC, they will understand that those things are valuable, and you'll be able to spend them. That won't be an issue at all.
Yep. All right. Well, that is all the time we have today. So, John, thank you so much for your time and your expertise today. I'm sure we'll be continuing this conversation because we barely scratched the surface. So really appreciate your time here.
Thanks, Chris. Talk to you soon.
All right. Bye-bye.